Somewhere between a late-night YouTube rabbit hole and a TikTok comment section, millions of Americans stumbled across a phrase that sounded almost too good to be true. Become your own bank. That's the pitch. That's the hook. And it is, without question, one of the most searched financial concepts of the last 3 years. Infinite banking, IBC, the bank on yourself strategy. It goes by many names, and its promoters will tell you it's the secret the financial establishment desperately doesn't want you to figure out. So today, we're going to do something most of those YouTube videos and TikTok reels never actually do. The small, minute details people don't really talk about. First, let's establish exactly what infinite banking is, because a staggering number of people throwing the term around online don't fully understand the mechanics themselves. Infinite banking is not a product. It is a strategy. It was originally developed and popularized by a man named Nelson Nash, who laid it all out in a 2000 book called Becoming Your Own Banker. Nash wasn't a Wall Street titan or a hedge fund manager. He was an Alabama-based financial practitioner who had a deeply personal distrust of banks and a deep love for whole life insurance. His core idea was elegant and genuinely creative. Instead of borrowing money from a bank and paying a bank interest, what if you borrowed against the cash value inside your own whole life insurance policy? You'd still pay interest, yes, but that interest would flow back into a system you owned rather than into a bank's quarterly earnings report. That is the foundational concept. You are, in theory, replacing the role of the bank in your own financial life. And on the surface, it sounds brilliant. Here's how it's supposed to work in the real world. You buy a specially designed whole life insurance policy. And that word specially designed matters enormously, so hold on to it, from a mutual insurance company. You fund it aggressively, often using something called paid-up additions to accelerate cash value growth. You do this consistently for years. Over time, a sizable chunk of cash accumulates inside that policy's cash value vault. And unlike money sitting in a savings account, this cash is growing at a guaranteed rate, completely tax-deferred and shielded from the IRS. Now here's where the banking part kicks in. Instead of going to Chase or Wells Fargo the next time you need $30,000 for a car, a down payment, a business investment, or a real estate deal, you call your insurance company. You borrow against your own cash value as collateral. The insurance company sends you the check. You have the money. You deploy it. And here's the part that makes people's eyes light up at financial seminars. Your cash value doesn't actually disappear when you borrow against it, because the insurance company is lending you their money, using your cash value as collateral. Your cash value stays fully intact inside the policy, continuing to earn its guaranteed growth rate and its annual dividend, as if you never touched it. Your $80,000 vault still shows $80,000. And you also have $30,000 in your hand to invest. In theory, your money is working in two places simultaneously. That is the infinite in infinite banking. The idea that your capital never stops compounding, even when you're actively using it. And that is a genuinely interesting concept. The math, in a perfect scenario, is compelling. The problem is that real life doesn't operate in perfect scenarios. And on the surface, it sounds brilliant. Because buried inside that strategy, deep inside the policy mechanics that no 60-second TikTok video will ever explain to you, is a distinction that quietly determines whether this entire concept actually works or spectacularly falls apart. It's called the difference between a direct recognition policy and a non-direct recognition policy. And it is, without exaggeration, the most important technical detail in the entire infinite banking conversation. Most people who are sold on this strategy have never heard those two terms, which is a problem, because they determine exactly what happens to your dividend the moment you take a policy loan. Let's break this down clearly. When you take a loan against your whole life policy, the insurance company has to account for the fact that your cash value is now being used as collateral. They do this in one of two ways, depending on how your specific policy is structured. A direct recognition policy directly adjusts your dividend rate the moment you borrow against it. In plain English, the policy recognizes your outstanding loan, and your dividend calculation changes to reflect it. Usually, that means the portion of your cash value tied up as collateral earns a lower dividend rate than the portion sitting free and untouched. Sometimes it earns a different rate entirely, one specifically tied to your loan interest rate. Depending on how the numbers shake out, the dividend reduction can partially, or in some cases almost entirely, offset the benefit you were supposedly getting by keeping your cash value working while borrowing. The very mechanic that makes infinite banking sound magical gets quietly diluted. A non-direct recognition policy does not adjust your dividend based on your outstanding loan balance. The insurance company pays the same dividend rate across your entire cash value, regardless of how much you've borrowed. Your $80,000 earns the same dividend as it always did. The loan exists separately, and the two don't talk to each other. This is the structure that infinite banking purists insist you must have. Without it, they'll tell you, the strategy loses a significant portion of its mathematical edge. And they're not wrong. But here's the uncomfortable commercial reality. Not every mutual insurance company offers non-direct recognition policies. Some of the biggest, most respected names in the industry use direct recognition structures. So when someone excitedly tells you to just go buy a whole life policy and start infinite banking, and they haven't addressed this distinction, they have either skipped the most important part, or they genuinely don't know it exists. Either way, it should make you nervous. Now, let's talk about the loan itself, because this is where the second landmine lives, and it's a bigger one. When you take a policy loan, the insurance company charges you interest. This is not optional. This is not a hidden fee. It's disclosed up front, and it's a fundamental part of how the loan works. Current policy loan interest rates typically sit somewhere between 5% and 8%, depending on the carrier and the policy design. Some are fixed. Some are variable, meaning they can fluctuate based on broader interest rate conditions. Now, here's the question that almost nobody asks clearly enough. If your cash value is earning a dividend of, say, 6%, and your policy loan is charging you interest at 6%, what is your net gain? Roughly zero. Not in every case. The math varies by carrier, by policy design, by loan balance, and by whether you're in a direct or non-direct recognition structure. But the point is this: the gap between what your cash value earns and what your loan costs you is often far narrower than the infinite banking promotional materials suggest. In the best-case scenario, with a non-direct recognition policy from a top-tier mutual carrier during a strong dividend year, you might genuinely come out ahead. Your cash value earns more than your loan costs you, and you've deployed capital into a real estate deal or business investment that generates additional returns on top. The math works. The concept delivers. But in a mediocre scenario, a direct recognition policy, a weaker dividend year, a loan balance you let sit and grow, the numbers get uncomfortable fast. And in the worst-case scenario, you trigger a tax bomb that nobody warned you about. Let's spend a moment on this, because it is the detail that genuinely keeps financial advisors up at night when they see clients dabble in this strategy unsupervised. A whole life insurance policy has something called a Modified Endowment Contract threshold, most commonly known as the MEC limit. If you fund your policy too aggressively in the early years, pumping in more money than the IRS considers appropriate for a life insurance contract, the policy gets classified as a Modified Endowment Contract. And once that happens, the tax advantages that make whole life insurance attractive are fundamentally altered. Loans from a MEC are no longer tax-free. Withdrawals are taxed as ordinary income, and early withdrawals before age 59.5 carry an additional 10% penalty, exactly like an IRA. Suddenly, your carefully constructed tax-free banking system just became a heavily taxed savings account with an insurance wrapper. But the MEC issue is only the first tax landmine. Here's the second one, and it's arguably more dangerous because it sneaks up on people slowly. If you take a policy loan and you do not repay it, the outstanding loan balance plus accumulated interest continues to compound quietly inside your policy. This isn't theoretical. This is just arithmetic. Year after year, if you ignore that loan, the balance grows. The interest compounds. And slowly, that outstanding loan begins eating into the cash value that was supposed to be your foundation. If the loan balance ever grows larger than your remaining cash value, your policy lapses. And when a policy lapses with an outstanding loan, the IRS treats the entire outstanding loan balance as taxable income in the year it lapses. Let's make this concrete. Imagine you borrowed $50,000 from your policy over the years. You never repaid it. The interest compounded. Now your outstanding loan balance has grown to $90,000. Your policy lapses. The IRS sends you a 1099 for $90,000 as ordinary income. If you're in a 32% tax bracket, you just received an unexpected tax bill for nearly $29,000 on money you already spent years ago. This is not a hypothetical horror story. This is a documented, recurring outcome for people who treat their policy like an ATM without understanding the repayment discipline the entire strategy demands. Infinite banking, done correctly, is not passive. It is not a set-it-and-forget-it system. It requires active loan management, consistent repayment, and a thorough understanding of the policy mechanics beneath the surface. The moment you treat it like a magic money machine, the way it's so often marketed online, it becomes genuinely dangerous. So who does this strategy actually work for? Let's be honest, balanced, and specific. Infinite banking, at its best, works well for a very particular type of person. It works for someone who already has a strong financial foundation. Emergency fund in place, no high-interest consumer debt, and a solid retirement contribution already underway. If you're still carrying credit card balances at 22% interest, there is no version of this conversation where borrowing against a life insurance policy at 6% should be your first move. Clear the high-interest debt first. That is a guaranteed, risk-free return that no dividend can match. It works for someone with high, stable income who can fund the policy consistently for years without wavering. Because the brutal truth about whole life insurance, and infinite banking by extension, is that the early years are a financial desert. The commissions, the fees, the cost of insurance all front-load into those first 5 to 7 years. Your cash value grows slowly at first. If life gets complicated and you miss premiums, the strategy begins to deteriorate. It works for business owners who have a genuine, recurring need for short to medium-term capital. If you run a business and you regularly need to finance equipment, inventory, or real estate deals, and you're currently doing that through conventional bank loans, there is a legitimate conversation to be had about whether policy loans make more sense for your specific cash flow situation. The strategy was essentially designed for this use case, and it works especially well as part of an estate planning strategy for high net worth individuals who have already maxed out every other tax-advantaged vehicle, their 401k, their IRA, their HSA, and are now looking for additional tax-sheltered growth. But for the average 28-year-old watching a TikTok video at midnight, getting excited about replacing their car loan with a policy loan before they even have a funded whole life policy? It's a dream being sold 3 to 7 years ahead of schedule. Here's a truth the infinite banking community doesn't love to advertise. The strategy requires what most people don't have: patience, discipline, capital, time, and a genuinely well-designed policy from a genuinely well-chosen carrier. Nelson Nash himself was very clear about this. His original book was not a get-rich-quick manual. It was a philosophy of long-term financial discipline. The banking metaphor was never meant to imply instant results. It was meant to describe a decades-long behavioral shift in how you think about and manage your capital. That nuance gets absolutely obliterated on social media. Instead, you get influencers with thumbnails that say, "I never pay interest again," and "how I bought a car with tax-free money," filmed in front of a bookshelf that happens to have one copy of Nash's book strategically placed in the background. They aren't lying, exactly. The strategy they're describing can work, but they're showing you the highlight reel of a system that has a brutally unglamorous first decade, and they're conveniently editing out the direct recognition mechanics, the loan interest dynamics, the MEC rules, and the lapse tax bomb. That's not education. That's marketing. Let's also address the philosophical argument head-on, because it's worth doing, honestly. The core premise of infinite banking, that you should recapture the interest you're currently paying to third-party lenders, is not crazy. In fact, it's conceptually sound. Think about how many times in your life you will finance something: cars, home renovations, business equipment, investment properties, medical expenses. Every single time you borrow from a bank or a dealership, you are paying interest out of your ecosystem permanently. That money is gone. If you could redirect even a portion of that interest back into a system you own and control, a system that compounds in your favor rather than theirs, the long-term wealth difference could be significant. That idea is real. That idea is worth taking seriously. The danger is not the concept itself. The danger is the assumption that the concept is simple, and the assumption that any whole life policy with a cash value component automatically qualifies as an infinite banking setup. It doesn't. The difference between a policy that works brilliantly for this strategy and one that quietly destroys it can come down to a handful of technical rider selections at the time of application. Selecting the right blend of base premium versus paid-up additions, choosing the right carrier, verifying the direct versus non-direct recognition structure, working with an advisor who is compensated fairly and isn't incentivized to oversell the base premium because that's where agent commissions are highest. These details are not footnotes. They are the entire strategy. There is one final thing worth saying, and it applies to every financial concept that becomes a social media trend. When something complicated gets popularized, it almost always gets simplified beyond recognition. Index funds became, just put everything in the S&P 500. Real estate investing became, just buy rental properties. Cryptocurrency became, just buy Bitcoin. And now, whole life insurance and infinite banking have become, just become your own bank. Every one of those simplifications contains a kernel of genuine truth. And every one of them has also led thousands of people to make poorly timed, poorly structured, poorly understood financial decisions because the nuance was edited out in favor of a clean, shareable headline. Infinite banking is not a scam. Used correctly, with the right policy, the right carrier, the right funding structure, the right loan discipline, and the right financial foundation underneath it. It is a legitimate, sophisticated strategy that genuinely works for a specific subset of financially disciplined people. But it is also one of the most aggressively oversimplified and overpromoted financial strategies on the internet today. And the gap between how it's sold and how it actually functions in a real policy, with real loan mechanics and real tax consequences, is wide enough to cause serious financial damage if you step into it unprepared. The question you need to ask is not, does infinite banking work? The question is, does infinite banking work for me, right now, with this specific policy structure, from this specific carrier, managed in this specific disciplined way? That question takes a lot longer to answer. But it's the only version of the question worth asking.